Good afternoon, everybody. Thank you for joining us.
Had a record number of attendees that joined us, mostly self-directed and retail investors, and several financial advisors too. We received feedback from many of the financial advisors requesting more frequent updates and more technical details. So in response to that, we're holding this financial advisor focused webinar, and we endeavour to do more frequent and shorter webinars on relevant topics for you. Look, certainly we at BetaShares do empathise with you presently. Many of you will be dealing with adjusting to new work practices, coupled with working with clients, your investors that maybe experience changes to their own employment, their businesses, and facing some financial stress. So certainly some ways we believe we can assist you is through webinars like this, our general market updates, portfolio construction applications, our analytics service, highlighting to you investment opportunities, and certainly reporting on some of our ETFs. So certainly we do welcome you on feedback on other ways that we can assist you. Look, today's webinar is not meant to be a detailed product presentation. I will reference some solutions in the context of the portfolio strategies that are presented, and certainly myself and your BetaShares account managers are available to provide more details if required. Just one before we start, a copy of the slides and the audio recording will be made available to you. There's a dialogue box there on the right-hand side where you can type in your questions. We'll attempt to discuss and address the questions at the end of the webinar. And certainly we will reply to every question that's asked via email straight after this webinar. Also, just need to highlight that this presentation is for financial advisors only. The content we are sharing has only been approved for financial advisors and should not be disclosed or forwarded to retail investors. And of course, this is general information only and does not constitute personal financial advice. So now, look, it's my great pleasure to introduce two of my senior colleagues. David Bassanese, Chief Economist. Many of you are familiar with David from either attending previous webinars, reading his written format materials that we produce, or even attending some of our advisor events in your capital city back in the day, back in February. He's been with BetaShares now for over 5 years, and previously he was an economics editor at the Fin Review and an economist with the OECD. Also want to introduce you to Louis Crous, our Chief Investment Officer. He's been with BetaShares now for 10 years, and he leads an in-house portfolio management team that has the ultimate responsibility of our investment outcomes of the BetaShares ETFs. Louis is also a CFA charter holder. Thank you both for joining us today and in collating some relevant information. So the agenda for today, we're going to cover really 4 main sections. We're going to cover the COVID issues and update on those, and particularly David will share his views on market scenarios on that. Louis will then cover a short update on the ETF market, and then followed by the main part of today's agenda, which is the investment applications. And again, this is in the context that many financial advisors will be undertaking portfolio rebalancing, particularly given market moves and rebalancing back to strategic weights. And that always presents an opportunity to revisit strategy selection, particularly in terms of more effective exposures or solutions and even lower cost solutions. So Lou will be covering the areas of portfolio rebalancing and some ideas around that, and he'll also share some ideas around tax management, particularly coming into June 30, and currency hedging too. I'll then briefly cover our whole of portfolio solutions, which entails our SMA models and our diversified ETFs. So let's start now. David, over to you, please, in terms of section 1 on the market views. David, are you there?
Yes, can you hear me?
Yes, we can.
Okay, great. Thanks, Vinnie. Thanks everyone for joining us. And as Vinnie mentioned, there's a lot to get through today. The economic and market outlook I'll cover. I'll take about 15 minutes, and then we'll take some questions. But really concluding with a few scenarios. I mean, really the best way to think about this is there's huge uncertainty going forward. There's various, upside and downside cases. I do have a central case sort of expectation, but I think you've also got to look at this at being highly uncertain, and there are different scenarios that may well play out. Just the first slide there, again, for those who've attended our webinars in the past, some of this may be over old ground, and I'll just sort of update some of the thoughts that I've been making on these in the past, but also some new information. And this is really just to compare the virus with past outbreaks. Obviously, this is not the first pandemic we've had. The most famously, going back to the 1300s with the Black Death, where it was very widespread and very high death rate. Spanish flu 1918, again, very contagious and a relatively high death rate, not helped by the fact that the healthcare systems back then were not as good as they are today. More recently, we've had the Asian flu, the Hong Kong flu, and then in 2009, the swine flu. And particularly also SARS, the outbreak in 2003. Now, just the influenzas we've had in the past, they've been very widespread in that they've been highly contagious, but the effective death rate, hospitalisation rates weren't actually that bad at the end. Well, relatively not bad. So it didn't require a closing down of the economies. Whereas SARS in 2003 was bad. If you did get SARS, the death rate was relatively high, at about 10%. But it wasn't as contagious because if you got the symptoms, it was pretty clear that you did have them, and you were basically contained before you were able to spread it too widely. So the big challenge of the coronavirus today is that it is as contagious as past outbreaks. And in fact, some estimates suggest even more contagious than the swine flu of 2009. Also with generally a relatively higher rate of hospitalisation. And high death rate, though, it remains to be seen at the end of the day how high that death rate will be, because there's a debate saying, it is actually more widespread in many countries than we know of at the moment. But the bottom line of it is that it's a very highly contagious, and if you just let it rip through the economy, you can lead to a major sort of backup in the hospital system, medical system, and a lot more deaths than would otherwise be the case. So that's what we're facing. And if you just go to the next slide, and really what governments have concluded, why this has turned out to be such a horrendous impact on the global economy and financial markets, is that barring any action, you can see this is from some scenarios in the US, is that the estimate suggests the peak in infections would be multiple times. Well, the demand for ICU units, hospital care, would be multiple times the available capacity. That's in the US, but it's also true around the world. And so governments have basically had to lock down their economies in the way that China did, and follow China's path to avoid this overrun of the hospital systems. So we've gone through social distancing, closing of schools and universities, and again, the scientists tell us that is the way to keep the infection rate down during this outbreak. Now, a couple of issues, as you can see in this slide, a lot of these projections are based on lockdowns for many months, more than 1 month. And I think one of the challenges for the markets will be that just because we're reaching potentially peak infections doesn't mean the lockdowns are going to basically be lifted carte blanche. And one of the problems is that, as you can see there, and we saw that the 1918 Spanish flu, is that you can get second waves. And if you just lock down the economy, do nothing else, then as soon as you lift those restrictions, people are as susceptible to the virus as they were beforehand, and you can get a reinstigation of the infection rates and repeated lockdowns again, which is something that the world dealt with in 1918, and that is a risk going forward. And if you look at you see that, so that with these lockdowns around the world, just go to the next slide, pretty devastating situation. So major cities around the world effectively deserted, people of being indoors. And that's obviously had a major impact on economic growth. Now, the positives are, if you just go to the next slide, tentative signs that you're seeing a peaking in the rate of new infections globally. So obviously in China, in Asia, they've well passed at least their first wave of infections. In Europe, also tentative signs, and also in some of the hotspots in the United States, and also most recently Australia as well. So that is a good sign. The lockdowns, devastating to the economy, though, do seem to be having an effect in that they are leading to a decline in the rate of new infections, which is what we want to see. Now, if you just go to the next slide, some of the hotspots really, Italy and US, I guess, are the most in focus at the moment. So Italy, in terms of Europe, had it the worst than most countries, though Spain and France, and to some degree the UK, are also negatively affected. But a lot of heart's been taken by the fact that the rate of infections in Italy have started to subside. And even over the past week, some signs in the US, it has started to subside again. Now, if you just go to the next slide, we'll be focusing on Asia. Now, this is what we need to watch out for, of course, is that you don't get a second wave of infections. And if you look at it, so Asia was hit first. They dealt with it earlier than everyone else, back in early February and January. And in Singapore, I mean, they are seeing a second wave of infections come through, and they've actually, having eased a lot of restrictions, had to reimpose them. Now, there's a debate going on. Some of those restrictions are imported cases, so local residents or Singapore citizens coming home and being infected, but they've had outbreaks amongst migrant workers as well. Areas of South Korea, I mean, they've still got it under control, but I mean, what we need to be watching for now is not just the fact that it's peaking in areas like Europe and the United States, but we don't get a second wave of infections in Asia, and most particularly in China with the Wuhan province, which just recently started to ease restrictions as well. Now, if you do start to get a second wave in China, I mean, China may not want to be that forthcoming in announcing that, but they really, if it does happen, I think there's ways and means in which the world will find out about it, and certainly if they reimpose restrictions, that would be an absolute, a body blow to the global economy and the confidence that we have that these restrictions would only be short-term in nature. So China has, and what we are seeing in terms of the economic data, I mean, again, more good news. I mean, this is why the markets have had a nice rally over the past few weeks, is that China went into lockdown. It had a massive slump in some of its indicators. More recently, the PMI indices have bounced back again. Now, again, just a note of caution there. It doesn't mean that everything's... All that means is that, on balance, many more businesses in March reported better conditions than they had in February, so that you had a big increase in that index. But it still means that overall conditions are still relatively weak in China. It just means relative to what they were like in February, they were better. Meanwhile, if you look at countries such as the United States, I mean, again, it's been remarkable the way the markets have managed to look through a lot of this. If you're just looking at the next slide there on the weekly jobless claims. So again, jobless claims, one of the best leading indicators of the US economy. During past recessions, they've spiked up to around about 500,000-600,000. More recently, it hit 3 million, and now we've had 2 weeks of 6 million in jobless. Just absolutely unprecedented, the collapse going on in the US labour market. So they've provided support to households, in that they've given people a direct income payment, about $1,500. But unlike in Australia, they haven't given wage subsidies. They haven't tried to keep people in their jobs, even if there's no sort of work to be done. And so the full brunt of the slowdown in the US is being borne by the labour market. And there's talks of the unemployment rate hitting, 20, 30% over the next few months by around June or so. But of course, the markets at this stage have looked through all this weakness, and the hopes is this V-shaped recovery. And again, Donald Trump's talking about lifting restrictions. Now they're past the peak wave of infections. But again, as I point out, I think the next leg of this may well be the markets are disappointed with the speed with which restrictions can be removed. Even in Australia, we're looking at restrictions continuing on into May. And then we need to be ever watchful of a second wave. And if you think about a business, I mean, if there is a second wave, business, we'll get a lockdown again almost immediately. So it's hard to plan and invest when there's a risk of a second wave and a risk of a reimposition of restrictions. So that in and of itself, even if you don't get a second wave, the fear of a second wave can really hold back the hopes of a V-shaped recovery. And really, until we get a vaccine, which again most suggest that even in an absolute best case scenario is 12 months away, we're going to face the overhanging risk of reinfections, second waves, reimposition of restrictions. And so that I think is going to limit the economic rebound that we get. So just got a slide there, all the various drug testing that's going on. I mean, again, there's a lot, you hear reports every day of yet another group with a potential vaccine. Now, it's one thing to have a potential vaccine. It's another thing to then do all the necessary tests to make sure, you know, it's what's the right dose you should be giving people. Will it have negative impacts on people? Will it have side effects? And you know, there are a lot of things that are being tested, but it still takes a while before you get one that can be, you know, definitely available and mass produced. And even Bill Gates is talking about, you know, 12 months away before you get a vaccine. No, meanwhile, you can get drugs. So there's, again, a lot of different drugs that are out that don't basically prevent the disease, but probably can treat people in a timely manner. And again, if we do get readily available drugs, and that's possibly closer within 3 to 6 months, that would reduce the risk of needing to reimpose restrictions should we get a second wave, because you'd think we could then treat people. So that's another sort of positive if that comes to fruition that we need to keep a close watch on. Meanwhile, in terms of markets, I mean, this is where we've been. These are the bear market, all the bear markets in the US, like peak to trough declines of more than 20%. I've split them between recessions and without recessions. No question the US is facing recession. It's probably facing the worst recession since the Great Depression. Incredibly deep downturn over the June quarter. But again, the markets are looking through that at the moment, hoping that it's a V-shaped recovery. But what we've seen with bear markets during recessions is they're usually not short-run affairs. These can play out over a year historically. The decline we've had today was the fastest bear market in history. We've had a pretty furious rebound more recently. It's not evident in that chart as yet, but that light blue line showing 2020, it has bounced back, probably given back almost half that decline. But I think going forward, there's going to be, you know, continued disappointment, and I don't think we've seen the lows, and I think this will play out for a little bit longer to come. And one of the reasons for that, if you just go to the next slide, is the earning. I mean, really, the markets are yet to factor in a massive cut to corporate earnings, not only this year, but next year. Like some people are saying, oh, the markets are forgetting about this year's earnings, are focusing on 2021. Well, the thing is that typically in a recession, both the current year and the next year's level of earnings get downgraded in a big way. So I think 2020 earnings will get downgraded, but that will pull down 2021 earnings as well. And I'm doing a blog on this later today. It'll be available in our newsletter on Wednesday, going through some numbers. But just penciling likely, you know, 30 to 50% decline in earnings for this year, and that having a drag down effect next year. The market at current levels is trading on what I estimate forward earnings will be in about 6 months' time, about 23 times earnings. Now, this slide here is basically a market estimate of the likely hit to earnings, and that is a futures contract for dividends as of the end of next year. Now, that has bounced back a little bit in the recent weeks, but it's still something like 30% down on the levels at the end of last year. Now, if you apply an average dividend yield of about 2% to the expected level of dividends at the end of next year, it suggests the market pricing of around about 2,000 on the S&P. So that just gives you an order of magnitude of, you know, what the market's pricing in, at least in terms of dividends. In terms of the markets, I mean, you know, we'll go into this cycle. I mean, we've been in this negative cycle where we've had rising infection rates, reactive policy responses, share market declines, and only now we're getting the weakness of the data and the earnings. But to some extent, the markets are trying to look through that and focusing on and jumping over to the next cycle where we get falling infection rates, share market stabilisation, and easing of restrictions. So we're in this hopeful stage at the moment. But again, I think it'll be a while before we can, you know, get to the improved economic data, and I think they still probably haven't factored in the fact that earnings need to be downgraded. Now, on the upside, I mean, I just the two positives for our market are the fact that the stimulus, if you compare today with the GFC, I think 2 points of difference are, A, the macro stimulus has been faster, deeper and more timely. And one of the reasons is that during the GFC, many didn't want to bail out the banks that were sort of the cause of the downturn. And so there was a lot of reticence about bailouts, about creating moral hazard. This time around, to the extent businesses are in trouble, it's really undeserved because it's because of a virus. It's not because of, like, you know, excess debt or that sort of stuff. So it's been a less pushback in terms of stimulus this time around, so which is helpful, but again, I don't think it's enough. The other point in terms of the overall US market, the tech sector, which has been leading the advance in recent, really in the bull market, funnily enough, is the sector least hurt by the lockdowns. So if you think about Amazon, you know, Netflix, Google, the tech companies, the online sort of businesses, who have been the most important sector in the bull market, also happen to be the ones least hurt by the downturn in the economy we're seeing. So that's helped hold up the US market in particular during this period. But again, ultimately, maybe the markets, I think, will need to do a retest of the lows, just to factor in what will be a significant downturn in earnings. It would be unprecedented, I think, if the markets can really look through a 30 to 50% decline in forward earnings over the next 6 months. But, you know, you never say never. That's pretty much it in terms of the outlook, is that we're very hopeful of, we're past the peak of infections, but the next stage will be how quickly we can lift those restrictions. And again, I think the markets may well be disappointed in how quickly they can be lifted. And even if they are lifted, how quickly business and consumers can bounce back, simply given the ever-present risk of a reimposition of restrictions until such time as there's a vaccine. I'll leave it at that and hand back to my colleagues.
Thank you, David. And I'm guessing, as a trained economist, you never thought you'd be conversant on infectious disease terminology. That was the domain of virologists.
That's exactly right. We're forced to learn about a lot of things in different market environments, but this is definitely a first. And really, I've spent almost the past month reading almost nothing but. I could bore you ad nauseum with all the various theories about, you know, whether this is a bad, you know, the disease is worse or not as bad as feared. But yeah, it's definitely it's causing us to learn a whole bunch of new things.
Yeah. So Dave, we've had a lot of questions come through, and some even came through before the webinar started. We might just take one because several people have asked this now. So we might just take a quick question. It's an important one for many of the financial advisors. And that is, how have your long-term asset class forecasts changed, or have they changed significantly given this crisis?
Look, in terms of long-run forecasts, like 10-year forecasts, to be honest, they wouldn't have changed that much. I mean, at the end of the day, I think, you know, we will get over this. A vaccine will be available. The economies will recover. I don't think we're talking about a Great Depression here of the 1930s where, you know, things stay weak for 10 years. I think it is definitely a period of weakness this year, but with then some recovery. If anything, you know, the long-run bond returns likely to be even less. I mean, it's even more likely that interest rates are going to stay lower for longer. But I think equity markets themselves, you know, have a downturn this year, but then start to recover. So it doesn't really upset, I think, the longer-term outlook for equity markets in particular.
Great, thanks, Dave. Please stay on the line, and we'll come back to some questions in a little while. So now let's move on to the next two sections, which will be covered by Louis Crous, our Chief Investment Officer. And again, he'll be covering a short update on the ETF market, and followed by the main section in terms of investment applications, and particularly as it relates to portfolio rebalancing. Louis, over to you, please.
Good afternoon, everyone. As Vinnie mentioned, today I'll firstly be covering how the ETF market has fared during the current market conditions, and then move on and briefly cover the need for portfolio rebalances within the asset allocation framework. And lastly, we'll look at 6 portfolio rebalancing strategies. So to start off, how has the Australian ETF market fared recently? Before we do that, I think it will be worthwhile just to take a step back and look at the pivot point when ETFs really started becoming more mainstream. By now, it's pretty well understood that investors like the ETF features of low cost, transparency, the choice of exposures, and then also the intraday liquidity. But interestingly enough, ETFs came to prominence during the global financial crisis, when investors really noticed the benefits of the enhanced liquidity profile, along with the ability to trade at a level that corresponds with the fund's net asset value, or NAV. Since then, the widespread adoption of ETFs has been nothing short of impressive. So when we're experiencing market stress conditions like we are at the moment, people naturally want to know how ETFs are faring. And this time is no different. And as you can see from the chart on the bottom left there, ETF trading volumes in Australia have increased fourfold over the month of March as compared to the monthly average for 2019. So that's just over 17 billion traded for March versus on average of roughly 4 billion per month for 2019. And even more interesting is the fact that as a percentage of the overall ASX volumes, ETFs participation has more than doubled. So from 2.8% on average for 2019 to 5.8% of total ASX trading in March. And this profile is also consistent with data that we've seen from international markets. Bid-offer spreads, and that's shown on the right-hand side there of the slide, they've remained relatively stable despite the market volatility. And the minor increase of late is very much in line from what we are seeing based on the increased spreads in the underlying security holdings. Also worth mentioning that ETFs often have the ability to show tighter spreads than the actual underlying holdings due to the impact of secondary market trading in the ETF vehicle. In other words, the natural two-way trading in the ETF itself can result in bid-offer spreads being less than what the ETF's actual underlying securities would show as the bid-offer spread. So that second layer of liquidity can be advantageous to investors. Last point looks at fund flows, and despite the market stress conditions, exchange traded products continue to take net inflows for the month of March. That number was roughly 340 million for the month, with Australian equity being the standout inflow with over $1.1 billion. And this in contrast to unlisted funds, which have seen net outflows over the same period based on available data to date. Now, before we look at portfolio rebalancing strategies, just a quick word on the importance of asset allocation and the need for rebalancing. So as we all know, one's asset allocation is a critical component of the risk and return profile of any portfolio over time. Rebalancing the portfolio to target weights may at times feel very counterintuitive or even lead to short-term losses for investors. So currently, given the market moves, investors will most likely need to buy growth assets again, and this may feel uncomfortable for some given the uncertainty in global markets and the world economy. But this is necessary, and this is the important point here. First and foremost, in order to maintain the desired risk profile over time. So it's crucial to keep that aspect in mind. And then from a return perspective, rebalancing is not done to maximize returns. In fact, you're likely to achieve greater returns over time if you don't rebalance, since the equity component will increase. But this will come at the expense of greater volatility also. So systematic portfolio rebalancing will, however, likely result in better risk-adjusted returns over time. Now, as mentioned, given the recent market moves, we would expect the majority of portfolio rebalances to consist of allocating to growth assets once again, and so a couple of the strategies today will specifically cover this rotation. Okay, so today we're going to look at 6 strategies that you may wish to consider as part of your portfolio rebalancing programs. Some of these are more regular strategies that can be implemented at any rebalance. And then, as you will see, some are very timely given the large market sell-offs we're currently experiencing. For the first strategy, and since we are assuming adding to the growth component, we are looking to add very low-cost passive Australian equity exposure as a core allocation in order to lower the overall fees in client portfolios. The first point to note here is that it is now pretty well understood that the majority of general equity passive investments do have performance merit also. The majority of them do not beat benchmark indices over meaningful timeframes, and so as I mentioned, they have performance merit. So in other words, it's not necessarily a trade-off between performance and lower fees. So the latest S&P SPIVA results are shown in the footnote on slide 28 for your information. The second point is that the cost savings and fees, however small, do add up over time. The tables in the middle of the slide showcase some examples of these cost savings, comparing a 7 basis point fee, which is the fee for the low-cost BetaShares Australia 200 ETF, which is the ASX code A200, versus, say, a slightly higher 13 basis points fee, and then also against a more average passive offering fee of 35 basis points. The difference in final values are shown in red, and despite only being a few basis points per annum, they are not insignificant as a final percentage value. The chart on the right merely confirms that the main Australian equity benchmarks have very similar performances over time. And here we are comparing the performances of Selective Australia 200 index versus S&P ASX 200 and the S&P ASX 300 indices. So performance difference of an ETF that tracks any one of these benchmark indices is not likely to be of any significance, but the fee associated with it is a known cost and certainly can be controlled. Slide 27 here just compares the management fees between A200, which is the lowest cost Australian equity ETF offering in any market, and the average management fee of similar ETFs. Okay, so that is strategy one, and that's rebalancing into a lower cost passive Australian equity exposure in order to reduce the overall fee profile for clients. For our second rebalancing strategy, we're also focusing on lowering fees. But for this strategy, you may want to consider adding some passive equity exposures with a specific investment focus. Passive investments have certainly evolved over time to offer more than just market capitalization exposures. And ETFs now offer exposures to a range of investment factors such as quality, value, growth, high dividend, and size also. So the development of research and the access to better data in these areas have allowed for index providers to construct investable indices that offer exposures to these factors, but certainly in more of a passive format. For many years now, active fund managers have also targeted these factors or have it as a byproduct of their specific investment processes. However, investors are now able to access those same factors, but at a much lower fee via ETFs. So let's look at two examples of what we're referring to. The first example is the investment factor of quality. And quality broadly refers to companies that have higher return on equity, or ROE, have higher stability and quality of earnings, and then also have lower financial leverage. This factor has proven to be a strong performer over the last few years, given the lower growth environment that we've been experiencing. And the chart on the left shows the performance of the benchmark of the BetaShares Global Quality Leaders ETF, ASX code QLTY, being the orange line, versus the performance of the MSCI World Index in grey. Again, these quality screens are broadly the same screens that are also used by many successful and well-known fund managers, some of whom you may be invested in. And just stressing the point again, it can now easily be accessed on market for a low management fee. Now, one of the features of a quality portfolio also is that it tends to have a lower drawdown during large market sell-offs. This chart compares the drawdown during the GFC for QLTY's benchmark index and versus the MSCI World. And as you can see, the drawdown is much lower. And I can also confirm that during the most recent sell-off that started on 19 February and up to the end of March, QLTY's benchmark index was down 9.5% versus MSCI World Index, which was down 14.5%. So 5% outperformance, and once again consistent with expectations. The next example in the strategy is where we combine a number of active investment screens for small cap portfolio. So, which in this case is the BetaShares Australia Small Company Select Fund, or ASX code SMLL. Very sensible screens, investment screens that are used, and that's screening out companies that have negative earnings, that have higher financial leverage or valuation metrics, and that have lower liquidity and momentum scores. And again, these are similar screens that are used by many small cap active managers, but it's investable at a much lower management fee. This slide 35 just shows the performance results against the S&P ASX Small Ordinaries Index. So I've shared just two examples with you today, but looking at our investment fund menu, you will notice there are other funds available also that offer targeted investment factor exposures. So feel free to reach out to your account representative to find out more about any of them. So that wraps up our second strategy, which looks at rebalancing into targeted investment factors, and which are often available from active fund managers, but with lower fees associated with them. And so once again, lowering the overall cost base for your clients. Moving on to our third rebalancing strategy, and this one for a change looks at a defensive allocation, and the most capital stable at that being cash. The interest rates all around the world, and now including Australia for that matter, have moved to near zero. When it comes to what many investors actually earn on platform, or even with their custodian, well, they're pretty much already at zero. However, cash allocations, they still need to be made for client portfolios, and for more conservative portfolios in particular, this can comprise a large proportion. But even for smaller allocations, it's quite important to focus on the actual return that you're receiving on your cash, since it's often overlooked and can add up over time. This table compares some of the choices available to investors, but again, pointing out that cash on many investment platforms and with custodians are already at zero. And also just want to highlight that the interest rate shown for the BetaShares Australia High Interest Cash ETF, the ASX code AAA, is a net rate, so after management fees. And is also one of BetaShares' most popular ETFs. So there are certainly some viable alternatives available that you can make, that can make your cash work harder for you, and that do not involve lots of paperwork and administration on behalf of your clients. Right, moving on to strategy 4. And strategy 4 looks at two things. One is helping you as advisors cut down your time and administration burden of not having to manage individual holdings on behalf of your clients. And two, recognizing that there are investment funds available that give you a diversified exposure at a very competitive fee. I guess one that everyone is familiar with is stocks, of course, that is holding individual stock names directly rather than investment funds. But I would actually like to concentrate on some of the other areas that we are seeing when talking to advisors. And that involves cash, hybrids, and also bonds. For cash, many advisors still administer numerous TDs on behalf of their clients. And unless the rates associated with those TDs are significantly more, they can easily be replaced with something like a high interest cash ETF. Hybrids is another example. Many advisors still manage individual hybrids on behalf of their clients, whereas a diversified exposure can be accessed for a low fee and thereby remove all the administration and complexity risk for advisors. I also mentioned bonds. Holding individual bonds for clients is not only an administrative challenge, but I would argue will often not be diversified enough. Advisors should look to access fixed income via very cost-effective diversified portfolios, with the added benefit that investment managers can actually access those bonds at institutional spreads. So this slide shows the BetaShares range of cash, fixed income and hybrid fund offerings available to investors, all available at competitive fees, with Australian fixed income here covering floating rate notes, investment grade corporate credit, and government bonds also. So that's strategy 4, where we look to consolidate individual holdings and switch to low-cost diversified exposures. For strategy 5, advisors can look to add value for their clients by specifically making use of the recent market sell-off in order to make tax-effective changes. As you can see from this chart on slide 44, given the significance and the pace of the recent market sell-off, there are now a number of points going back a few years where the cost base for Australian equities would be higher than the current level. And this example looks at the S&P ASX 200 price index as the proxy. So in the past, we have often heard from advisors that certain investments or strategies do make sense to them, but rotating into them would crystallize unnecessary capital gains from their current positions, and therefore they are reluctant to proceed. Now is the time to revisit these investments, as it may be likely that gains are either low or even in a loss position. And capital losses may, of course, also be used to offset against any capital gains generated in the financial year. So examples of specific investment strategies that have been on many advisors' radars include switching into lower cost broad market exposures or accessing effective investment factors to replace active managers, which we discussed under strategies 1 or 2. Just a quick comment on the execution. BetaShares can also assist when it comes to the execution of any switch trades, and assuming we are dealing with a switch between 2 ETFs. Often cost synergies exist when selling one exposure and buying one another. And rather than just crossing both a buy and sell spread, specialist ETF execution agents are able to quote tighter spreads for such a switch trade. And BetaShares will be more than happy to guide you through this process and put you in touch with the most appropriate execution specialist. So that's strategy 5, where one can use the recent market sell-off in a tax-effective manner in order to switch into particular investments or strategies. Right, so our last portfolio rebalancing strategy today looks at allocations to Australian dollar currency-hedged investments. The Australian dollar has seen a significant fall over the last month in particular, and as can be seen on this slide, a fall that has taken it past the GFC lows and back to 2003 levels. The sell-off was also fairly broad-based versus many currencies, so not just confined against the US dollar. So over recent times, an unhedged international exposure would have provided significant additional returns from the currency impact alone. So for example, over the past 12 months to the end of March, the S&P 500 index was down 7% in US dollar terms, but up 8% in Australian dollar terms. That's a 15% difference in returns. So given the rapid decline in the Australian dollar, it's probably a good time to ask oneself whether having some currency hedging in place now makes sense for clients' portfolios. And advisors have plenty of choice when it comes to currency hedging exposures available using ETFs. BetaShares also offer a range of currency hedged funds, which are listed on this slide, and we'll also be looking to add to this list in the near future. So that concludes the portfolio rebalancing strategies for today. It's been a pleasure sharing this with you. I'll now hand over back to Vinnie and be available for Q&A at the end of the presentation.
Fantastic. Thank you again, Louis. And please stick around because there are a fair few questions that have come through for both yourself and David. Look, I'm not going to recover a lot of things that Louis just mentioned, but by way of reference simply, this summary slide here is just to highlight some of the relevant product solutions that are applicable to the portfolio strategies around rebalancing outlined by Louis. I just want to reiterate the point around the switching. We at BetaShares pride ourselves on a very capable capital markets team. And if you're able to call anyone at BetaShares, your account manager, our general line, they'll put you through to our capital markets team to assist with that. And it really comes down to, some favourable pricing around the buy-sell spreads. We can assist with that. We may be able to assist with that. The only other point, and we've listed out the ticker codes here that relate to the lower management fees that Louis covered. Some of the targeted investment factors too. We have a whole suite of these that also cover value investing, global income investing. Any additional point I'll make on AAA is that this really is a very accessible, easy way here to get a pickup on your cash return, particularly for those strategic cash allocations that are on platform. And you'll know some of the platform cash rates at the moment, which are very low. And then across on the consolidating individual holdings, The additional interesting point with the Active Australian Hybrids Fund, Louis mentioned the very broad diversification that this fund offers, some 35 odd hybrid securities. But importantly also, this is really meant to be, this is a capital structure solution. And that's reflective in the fund's objectives and the fact that it's actively managed. On fixed income, so CRED, Louis touched on this, is our Australian investment grade corporate bonds. The current yield to maturity on this is 3.2%. We will be publishing a note to advisors either later today or tomorrow morning, highlighting two things. Firstly, just the relevance of investment grade corporate credit as part of your strategic fixed income allocation, but also the opportunity that's presented right now, and that's really centred around the normalisation of spreads for investment grade bonds. So look out for that note. We may even cover this as a separate short, or fixed income as a separate short webinar in the foreseeable future. And on the currency hedging, Louis highlighted some points there, but the ones I really wanted to just bring to your attention just very briefly is really two, and that is around gold bullion currency, that's QAU, gold bullion currency hedged. So this is gold bullion in US dollars. And now that's the currency that this asset class is priced in. To have an unhedged gold position essentially means you are embedding a currency bet in your either strategic or directional gold position. So QAU is the currency hedged gold. And the other interesting one is DRUG, which is the ticker code for our global healthcare ETF. Our healthcare pharmaceutical, medical equipment companies are holding up pretty well in this crisis. Louis certainly made the point around currency hedged exposures now. So here is a fund that you can access the share price of these or the share growth of these companies without the currency impact. And the other distinguishing point here for the DRUG ETF is that it's ex-Australia holdings. So unlike some other exposures, you're not doubling up on your Aussie equity exposures like CSL, Ramsay, Cochlear and Sonic. It is purely a global portfolio. So thank you for that. We'll end the portfolio rebalancing strategies there, and certainly we're very happy to further discuss with you as a follow-up on a conference call. In the very short time that we do have, I just wanted to quickly touch on our whole of portfolio solution. So we focused a lot on the investment applications as part of rebalancing, but those same tenets about lowering cost, more effectiveness can apply at the total portfolio level. And just briefly, many of you are familiar with this, but certainly in recent times, model portfolios are getting a lot more interest and strong adoption. Traditionally, model portfolios meant that you outsource that portfolio management function, but it doesn't have to just be that. Some advisors have gone down that path, and others want to retain that function. So certainly model portfolios do still meet that need. But interestingly, certainly from myself and my other account management colleagues are seeing model portfolios used in different ways too. And that is a solution for a specific client segment. That can be portfolios, say for example, we've seen one with several advisors, any portfolio with a dollar value below 300,000 is a low cost solution as a SMA model portfolio. And the advisor then retains the full portfolio management for higher dollar value portfolios. The third way is a core satellite approach. So a low cost ETF SMA model portfolio can be a core part of the portfolio, say 50, 60%. And then as an advisor, you retain the satellite thematic investing or client preferences around that core. And certainly the platform technology allows that to be done in a very efficient manner. And also the last point, interestingly, with SMA models, particularly via platform, we're seeing some all-in pricing coming in at around the 70, 75 basis points mark. That includes the underlying investments, portfolio management and administration. And at that fee scale, it actually is quite competitive against some of the industry super funds. And of course, with an approach like this, a model portfolio, you have total transparency and look through on the underlying holdings and portfolio. I know we're a little pressed on time here, but many of you are familiar with the BetaShares offering. We launched our asset allocation and model portfolio service back in 2015. And in 2018, we launched them as SMA model portfolios on several platforms. Some of the distinguishing features of the BetaShares SMA models are that we undertake dynamic asset allocation. We have a philosophical belief that by undertaking DAA, we can do one of two things: generate alpha. We believe asset classes can be under, over, or fair value, just like securities and bonds can. So we want to capture that alpha. But importantly also is to manage downside risk. Here's a snapshot straight out of our freshly minted DAA report on the 31st of March, where you can see what our current DAA weightings are. So we are marginally overweight defensive assets, underweight growth assets. And the other very key distinguishing feature you can see is that the underlying ETF selection is a best of breed approach. It's not just BetaShares ETFs that are in this portfolio. So we've taken a best of breed approach, and we have also selected other ETF managers' ETFs, and you can see them there. Around this, we provide very comprehensive support material. We provide material both for yourselves as advisors and also material that you can actually forward to your clients too. So let us know, and we're happy to share that with you. Advisors that are utilising our SMA model portfolio service on platforms also have access to a very wide range of support and reporting. It ranges from SOA templates, monthly fact sheets, detailed quarterly reporting where we have embedded videos, and access to our Chief Economist, David Bassanese, and our portfolio management team, including Crous. So please let us know. We're happy to share a lot more information on that. And due to the strong interest and demand, our SMA model portfolios are now live on numerous platforms that we've listed there on the right-hand side of this page. And again, these are as part of the PDS of these platforms in the super menu. And of course, we can run through a whole lot of benefits of an SMA functionality, but the big one that many advisors most benefit from is no ongoing ROAs in terms of the portfolio changes here. And lastly is just a quick point that BetaShares also has launched a suite of diversified ETFs that are listed on the ASX. So these are accessible, not necessarily have to go through a platform. They're a very low cost at 26 basis points. And you can see the 4 risk profiles that have launched, and including the ASX ticker codes. On our website is a lot more information on these diversified ETFs, including the underlying holdings. Again, we've taken a best of breed approach, and you can see the current underlying holdings there. And again, these are very beneficial, particularly in terms of their low cost, and particularly for certain types of investors. Those that are embarking or starting out on their investment journey through life, provides a low cost diversified portfolio, and it has various other applications also. I might pause there now, please, and take some questions in the few minutes that we have remaining. Dave, there's a question here for you. Are you still there, Dave? David, you might just have to unmute yourself, or...
Okay, sorry, can you hear me now?
I can hear you now.
Great, okay.
Dave, we might take a few questions here while we've got a few minutes.
Sure.
Well, there's 2 that I might put to you here. Firstly, we've got one from James from Adelaide. How will the government pay off the debt, and what are the implications of that?
Well, I guess there's various options. I mean, there's a lot of talk that, you know, they're going to have to raise taxes significantly to pay off the debt. Look, I don't think they will at the end of the day. I mean, what it basically means is that as the economy recovers, hopes of, you know, infrastructure spending, even more significant tax cuts are now out the window. So obviously they can't do the sort of things they hoped. I still even think they will go ahead with the tax cuts that are still factored into the budget. And the way we pay off this debt is to basically grow our way out of it. So debt will eventually be whittled down As the GDP expands, as the economy expands, the budget will eventually move back into surplus. I know that sounds hard to believe, but the budget does tend to go to surplus as the economy grows, and then with a surplus, you'll start to pay down that debt. So I mean, yeah, they'll need to have substantial surpluses going forward at some point. And so, yeah, bottom line is a strong economy and a rebound in the economy is the way, as we saw coming out of World War II, these sort of things. That's the way we pay down the debt.
Great, thanks, Dave. And one more for you too also is, and maybe just do this at a high level, certainly we'll be publishing a report on this, but what are your current DAA views in your models?
Well, as Vinnie mentioned, look, we did take a call. We basically have gone, the main tactical tilt at the moment is to be underweight growth assets on the view that the market is probably going to retest its lows and in fact possibly significantly fall below those previous lows. So we're just, again, talking about trying to protect some of the downside of that. And certainly, given where markets are now, I think there's certainly a lot more downside than upside from where we are. So that's the main view. And again, we'll be very agile and alert to if the market does sell off again, and I think starts to price in what a more realistic outlook for earnings, we could actually then switch to at least neutral, if not go overweight at that market bottom. We're not trying to pick the bottom, but we just think given where the markets had fallen, there probably hadn't been enough of the negativity priced in. Obviously, markets have since rebounded somewhat a little bit, but we think that's really still just a bear market rally. So that's the main positioning, but we're obviously looking at things very, very closely on a continuous basis at the moment, given the extreme volatility.
Thanks, David. Look, Louis, one question for you is why is the yield so high on CRD and versus an index? I'm guessing that means the Osborne comp.
Yeah, sure. So if by the index you mean Osborne Composite, yeah, that's the broad bond composite in Australia. The reason for the difference in yields, well, firstly, the investment grade corporate credit ETF will have high yields as a natural course because it's taking on credit risk, as opposed to the broad composites, which is a mix of corporate credit but also government issuance. And the level of government issuance has actually increased quite a bit over the last few years. And if you actually look at what's happening now, that participation will actually increase further given the quantitative easing programs that certainly the RBA is undertaking. So credit only makes up around 12% of the Osborne composite. So the rest being made up of government and government-related issuances. So their yields are generally speaking a little bit lower anyway, and so that's what I'm saying. Naturally, there would be a difference in yields, but what we did see recently is a significant widening in the credit spreads in even investment-grade paper. And bearing in mind both the Osborne composite and our cred ETF they're all investment-grade issuances, but there's been a significant widening in credit spreads, and that's one of the largest widenings we've seen over the last 15 years. So that's widened to, as Vinnie mentioned, about 3.2% yield, which can be seen by many people as quite an attractive yield to enter into corporate credit.
Thanks, Louis. Comments that you didn't hear my question at the beginning. The question was simply why is the yield so high on cred, and how does it compare to the broad market index? Well, as I mentioned, we will be publishing a very detailed note on income and investment grade corporate credit within the next 24 hours. So please look out for that. We'll also may run another focused webinar for advisors just on fixed income. One final question that's been asked, which is what is the breakup of the costs of the SMA model? How did you get the 70 basis points or thereabouts? I'll take that question. So, the breakup is the balanced portfolio has an underlying ETF management cost of 22 basis points. Via a platform, there is an additional circa 19 basis points in terms of SMA management and portfolio management. That takes it to 41 basis points. And then what we've seen is that and then the additional cost onto that is the platform administration. Now that's something you as an advisor or your dealer group will agree with the platform, but generally we've seen some platform administration's fees around the 30 basis points mark. Hence the total all-in cost is around 71 basis points. We may have to leave it there. We certainly will come back to you on all of the questions that you've asked. We trust that we have shared with you some important information, particularly around the market's current state on the crisis, and importantly, some investment strategies and applications around portfolio rebalancing, including the whole of portfolio solutions. Please provide us with feedback. It's very valuable to us. You're welcome to reach out to your BetaShares account manager or send us an email on info@betashares.com.au. I reiterate, we'd welcome your feedback in terms of future webinars. And lastly, and on behalf of the BetaShares team, I wish you, your team and your families the very best wishes throughout these challenging times. Thank you.